Hello, everyone, and welcome to today's webinar with Bureau Veritas on Demystifying California's Climate Reporting. My name is Allison Carlson, and I am the training specialist here at Bureau Veritas North America. We're going to go ahead and just jump on in here. There's a lot of information we want to get out to everybody, but before we do, I do want to give a little bit more of a background on Bureau Veritas. Bureau Veritas is a world leader in inspection and certification services. Created in 1828, the group has approximately 82,000 employees located in more than 16,000 offices and laboratories across the globe. Bureau Veritas helps its clients improve the performance by offering services and innovative solutions in order to ensure that their assets, products, infrastructure, and processes meet standards and regulations in terms of quality, health and safety, environmental protection, and social responsibility. Bureau Veritas is a business to society service company that contributes to positively transforming the world we live in. We work closely with our clients to address the critical challenges they face and to link these to emerging aspirations of society. We work with companies to build and protect their reputations, supporting them as they forge the foundations of trust that are built to last. And just two things I really want to hone in on here is our inspection and certification. Our inspections involve on-site verification that products, services, assets, and facilities meet specifications and operate as intended. They cover a wide range of services designed to control quality, verified quantities, and meet regulatory requirements. Our inspection services help companies have confidence in the reliability and integrity of their products, assets, and systems. And our certification. As an independent third party and accredited certification body, we provide certification services to attest that management systems, services, and personnel comply with specific standards. Equipment and products can be certified to meet sector-specific or industry standards, international, local, or voluntary standards, or manufacturer clients' requirements. Certification enables companies to access new markets, strengthen their brands, or simply obtain license to operate. And I do want to go over a few housekeeping things here for the webinar for today. I will be keeping microphones and cameras off during the entirety of the webinar. If you do have any questions, please use the Q&A chat box. We really want you guys to use this and engage with the questions we will be asking. We want to know what our clients are needing that may not be getting met outside of this as well. If you do not get your questions answered, our speaker today will be reaching out via email to make sure you do get those questions answered. And we also will be recording this webinar today, and we will get this to you via email once it's completed. So I would love to introduce to you our speaker for the day. Her name is Brianna Hardy. Brianna has advised companies of all sizes across the industries and maturity levels on leading sustainability practices that drive better business outcomes and ensure compliance with evolving regulations. With a strong focus on corporate sustainability and an expert in climate reporting, Brianna leads engagements that enable organizations to accurately access, manage, and disclose climate-related risk and opportunities. So without further ado, I'm going to go ahead and hand it off to Ms. Brianna herself, and we get to learn all about this climate. Go ahead and take it away.
Awesome. Thank you, Allison. I am going to go ahead and switch to share my screen, so bear with me all just a moment. All righty. Well, thank you all for joining today's webinar. I am really excited to dive into California's mandatory climate disclosure regulations, Senate Bill 253 and 261. I have personally been following these regulations since they were introduced back in late 2023, so almost 2 years now. And I'm really excited just to chat about the bills themselves. We'll talk about an update that CARB provided a couple of weeks back. We'll also discuss the key elements of the TCFD framework and talk about the benefits of disclosing in alignment with that framework. So with that, let's dive in. So before getting into the meat and potatoes, I really want to level set on Senate Bill 253 and 261. Some of you, like me, have been tracking these regulations for the past 2 years, while others are really just starting to come up to speed on the disclosure requirements that are coming up in 2026. So to get started, I want to kick off here with Senate Bill 261. This legislation mandates that companies with 500 million or more in revenue that are doing business in California publicly disclose a climate-related financial risk report on a biannual basis, so every other year. The first report is going to be due January 1st, 2026. And unlike Senate Bill 253, this regulation is not hung up in the rulemaking process or awaiting finalized timelines. Companies will be required to report by January 1st, 2026 for those that trigger the threshold. This legislation requires that these climate risk reports are disclosed in alignment with the Task Force on Climate-Related Financial Disclosures, also known as the TCFD, a mouthful. This framework is globally recognized. It provides a standard and comprehensive approach for companies to assess, manage, and transparently report on their climate-related risks and opportunities. Importantly, this new regulation applies to a broad range of companies doing business in the state, regardless of their headquartered location. So most organizations that meet that 500 million revenue threshold and have a presence in the state will be subject to these disclosure mandates, but we'll dive more into the specific thresholds shortly here. So the next regulation worth noting here, Senate Bill 253. This piece of legislation requires companies with 1 billion or above in revenue that are doing business in the state to publicly disclose their Scope 1 and Scope 2 greenhouse gas emissions starting in 2026. And then a year later, they will also need to report on their Scope 3 emissions. There's obviously a lot of questions surrounding Senate Bill 253 because there are timelines, assurance requirements are still pending finalization by CARB, and we'll talk about that as well. It is important to mention Senate Bill 219 when we're talking about Senate Bill 253 and 261. Senate Bill 219 amends and streamlines some of the climate reporting requirements that we see in SB 253 and 261. So important to note, Senate Bill 219 granted CARB, the California Air Resource Board, until July 1st, 2025 to develop and adopt implementation requirements for emissions reporting specifically. So again, that's going to be Senate Bill 253. However, based on an update provided by CARB a couple of weeks back, it is not likely that the ruling will be final by July 1st of this year, but more likely towards the end of 2025. Another amendment, previously companies were required to report their Scope 3 emissions within 180 days of their Scope 1 and Scope 2 disclosures. Now CARB has the discretion to determine the timing of these Scope 3 disclosures, although it is still expected for Scope 3 to be required beginning in 2027. Another key amendment that Senate Bill 219 introduced is the concept of consolidated reporting for companies. So under this new rule, companies can now consolidate their greenhouse gas emission reporting at the parent level, simplifying the process for companies that have various subsidiaries. And then lastly, the requirement to pay filing fees upon disclosure submission has been removed. However, there is still an annual fee obligation, which remains in place to help fund the program. So with that being said, let's dive into those threshold requirements, which is where many of you may still have some questions, such as myself. So since the regulation does not clearly define what doing business in California means, many, including CARB, have been looking to the California tax code. So the tax code is going to state that you are considered to be doing business in California if you engage in any of these listed on the screen here. So if you engage in a transaction for the purpose of financial gain within the state, you're organized or commercially domiciled in California, or your California sales, property, and payroll taxes, payroll exceed the amounts shown on the screen. However, this is not the definition that's been adopted by CARB. It is one recommendation that CARB is considering. So more to come on what it truly means to do business in the state of California. That takes us to the workshop, the 3-hour workshop that CARB hosted 2 weeks ago. And really what they provided was an overview of their rulemaking process. So you can see 3 different steps here. That first step, the climate disclosure program direction and development step, took place from December 2024 to March 2025, in which a information solicitation process took place. There were a number of comments received from public commentators, with a key theme emerging that there are a number of terms and additional guidance that needs to be clarified in the final ruling. So things like doing business in California, revenue, parent subsidiary relationships, protocols for greenhouse gas emissions reporting. Those are all key themes that people like myself and people like you are still awaiting for final information from CARB on. So the next step in the process is the climate disclosure pre-rulemaking process, and this reflects where we are today. So CARB is holding an informal workshop to achieve a couple of key objectives. So first, they want to identify the key regulatory concepts that need to be further defined. So some of those things that I just stated. They also want to investigate if there's anything else in the text of the legislation that requires further refinement and defining. They also would like to discuss how the proposed regulation aligns with the initial legislative intent. And lastly, they want to solicit valuable input from the public and key stakeholders. So I have bolded and highlighted this bullet point because it is an opportunity for all of us on the call today. If you have feedback, comments, questions regarding Senate Bill 253, greenhouse gas emissions reporting, now would be your opportunity to share that feedback, share those questions, those comments with CARB. Allison is going to drop in the chat the email to CARB that you can email directly with all of your feedback. Your feedback will then be posted on the CARB's website. And they are monitoring those inboxes. I would say they are actually quite receptive to any feedback that you have. So I recommend, as an action item, if any of you have some really strong opinions about the regulation or just some questions, feel free to send an email over to that CARB email address that you'll find in the chat. The next major milestone in CARB's rulemaking process is the climate disclosure formal rulemaking step. So during this step is when CARB will issue their formal notice of proposed rulemaking. This will then kick off a 45-day public comment period, after which the regulation can be adopted by CARB. Obviously, once adopted, it can then move into the implementation phase. We will continue to monitor this process as it continues, and we will keep you all updated. But you can see here, given that there are still a number of steps to be carried out, it is very unlikely that CARB will have their finalized rule by July 1st. Again, they have not stated that they will not meet their July 1st deadline. However, it's very clear that they likely will be looking towards the end of 2025 before the final rules are released. Moving on, I'd like to take a look here at the disclosure timeline from a comprehensive view. So this is specific to Senate Bill 253 and 261. And what we're seeing here is that starting in 2026, for businesses that trigger both of those thresholds, you will be required to submit two separate reports. A climate risk report, which will be due on January 1st, 2026, and every 2 years thereafter, so 2026, 2028, and 2030. This report will provide an assessment of the company's exposure to climate-related risks and plans to mitigate those risks. And then the second of those reports is going to be your greenhouse gas emissions report, covering Scope 1 and Scope 2. The report will be due sometime in 2026 and will need to be accompanied by a limited assurance statement from a third-party verifier, beginning in 2026 and annually thereafter. Looking ahead to 2027 and beyond, the greenhouse gas emissions reporting requirements will expand to include Scope 3. This means that companies will need to disclose their direct emissions from operations, Scope 1, indirect emissions from purchased energy, Scope 2, as well as their indirect emissions from their value chain, Scope 3. The assurance requirements for these greenhouse gas emissions reports will evolve over time, and they are phased in. So by 2030, the assurance level for Scope 1 and Scope 2 will move from limited to reasonable. And then in 2030 is when limited assurance will be introduced for Scope 3. Now, I say all of that, and I have this timeline on the screen, but of course we know that CARB is still finalizing this timeline. They have indicated that they'd like to keep the timelines that were previously communicated, indicating that companies do still need to report their emissions per the existing schedule, but it is a potential scenario in which we will see some of these dates shifting. Also important to note is a notice that was shared by CARB while back on the enforcement of Senate Bill 253. So CARB has stated that for those companies that demonstrate a good faith effort in disclosing their fiscal year 2025 greenhouse gas emissions, which again are going to be disclosed in 2026, there will be no enforcement action. This is because CARB recognizes that many companies may not currently possess or collect all of the relevant information needed to provide a complete scope 1 and 2 inventory. So implementing these new data collection and reporting processes can take time and resources, and CARB is very well aware of that. So they're granting companies a little bit of enforcement relief as we look to the 2026 reporting year. Another important trend that I'd like to chat about is the trend that we're seeing in state level regulations. So regulation from California is bringing about a larger trend. We can see through states that are proposing regulation in New York, New Jersey, Illinois, and Colorado. In the absence of federal climate regulations, state level actors are stepping in and beginning to mandate climate related disclosures. There seems to be a strong consensus amongst these states on the need for standardized climate reporting. By proposing regulations that resemble California's framework, these states are signaling a desire for a more unified approach to climate disclosure requirements. And really what this is telling us is that soon it is going to be a bare minimum in order to do business in these states to disclose climate related information. Now that we've chatted through the requirements of Senate Bill 253, 261, and those amendments by Senate Bill 219, would like to dive into the TCFD framework. So the TCFD framework is specific to Senate Bill 261, where you are required to disclose a climate-related risk report, assuming you trigger the threshold. This framework is recognized globally as the main framework to report climate-related data and information. You will find the TCFD referenced in regulations such as ISSB's IFRS S2 standard, the CSRD European Sustainability Reporting Standards, and other jurisdictional level reporting across the globe. So it really does reflect a best-in-class framework. And the framework is really designed to help organizations provide climate-related financial information to investors, lenders, insurers, and other stakeholders. So the framework is a set of comprehensive recommendations that cover these 4 key areas. So governance, strategy, risk management, and metrics. By covering these 4 key areas, this ensures that companies provide a comprehensive and standardized set of climate-related disclosures. So diving in a little bit deeper to each of them, the governance section is going to require companies to disclose information about the board's oversight over climate-related risks and opportunities, as well as management's role in assessing those risks, It's important for companies to demonstrate how climate change is integrated into their overall corporate governance structure and decision-making process, and that's really at the heart of the governance pillar. Under the strategy pillar, companies must disclose the actual and potential impacts of climate-related risks and opportunities on their business, strategy, and financial planning. This includes identifying the climate-related risks and opportunities they face in the short, medium, and long term, and how those factors are incorporated into their strategic planning. This would also be the time that companies are required to conduct a climate risk assessment in order to identify what those key areas of risk are and what the opportunities are as well. In the risk management section, this requires companies to explain their process for identifying, assessing, and managing climate-related risks. This really helps stakeholders understand how climate change is being integrated into the organization's overall risk management framework. And then lastly, the metrics and targets pillar focuses on the disclosure of relevant climate-related metrics, such as your greenhouse gas emissions, as well as any targets, such as a science-based target or reduction target that you may have set. Providing this data allows for better evaluation of a company's climate performance and progress over time. So really looking a little bit deeper into the framework, it is focused on financial material risks that have financial effects. So the framework reviews risks in these two different buckets: physical impacts, which are the impacts these risks could have on businesses through extreme weather events or by longer term disruptions caused by weather patterns, rising temperatures, sea levels, etc. And then transition risks are those risks related to changes in policy, technology, changes in the market as we transition to a low carbon economy. And excuse me, companies who don't adequately respond to these changes may also be exposed to various reputational risks as consumer expectations change. The financial impacts of these risks, you can see on the bottom here, are important for companies to consider. This can result in supply chain disruption, increased costs of raw materials, damage to facilities and assets, changes in customer demand resulting in decreased revenue, increases in insurance premiums, among many others. So depending on your company, the sector you operate in, and where you may be most exposed, your risks as a company are going to vary. But this is a really good guideline to follow as you identify and assess those risks. Here's a quick look at the table of recommended disclosures, which can be found within the TCFD recommendations report. And that's going to go through all of the recommended disclosures at an industry agnostic level, as well as at a sector specific level. So now that we've reviewed the TCFD framework and have an understanding for what disclosures to include, let's chat about the benefits of aligning with this framework. So first and foremost, aligning with the TCFD framework allows for improved risk management, improved risk assessment and risk management. You'll be required through the TCFD's recommendations to thoroughly assess and disclose your organization's climate-related risks and opportunities. This in-depth analysis can help you better understand your exposure to climate change and enable you to develop more robust risk management strategies. Improved climate risk assessment and mitigation can ultimately strengthen your organization's resilience and long-term sustainability. The second benefit is enhanced transparency and investor confidence. The TCFD framework promotes transparency by requiring comprehensive disclosures on your climate governance, strategy, risk management, and performance metrics. This increased transparency really does help build trust and confidence among investors, lenders, and many other stakeholders. And lastly, aligning with the TCFD really does promote consistency with other global reporting standards and questionnaires. For example, the upcoming CSRD ESRS framework references many of the different pillars that you'll find in the TCFD framework, as well as the IFRS's ISSB S2 standard, which is specifically related to climate disclosures. Additionally, many prominent sustainability questionnaires that you all are probably familiar with, such as CDP, are based on the TCFD framework, allowing you to leverage your TCFD-aligned reporting within your disclosure directly. So with that being said, I want to just quickly hit on some of the services that we offer here at Bureau Veritas. You can see the breadth and the depth of services that we have in the sustainability arena. As a global leader in testing, inspection, and certification, BV has extensive experience in providing high-quality advisory services that help organizations demonstrate their commitment to sustainability and achieve their environmental goals. We've assisted clients with projects like carbon footprinting, net zero strategies, verification, and sustainability and climate reporting, among many others. If you have any questions about some of our services or just want to ask a question, feel free to reach out. Allison will drop my email address as well as my LinkedIn, and you are more than welcome to reach me either of those ways. Before we formally wrap up here, I would like to share excuse me, a note about an upcoming 3-part series that we have called Aligning with California's Climate Disclosure Requirements, a Roadmap for Businesses. So I will be teaching this 3-part training series that is coming up here in July. This will be delivered over 3 3-hour sessions starting in July, excuse me, and running through September. Each session will build upon the previous one, providing a structured approach to preparing your business for California's climate-related reporting requirements. So we'll execute things like a gap assessment, identify risks and opportunities through a climate risk assessment, as well as review the various reporting processes and data required to be in place before the 2026 deadline. So with that being said, Allison, I'll pass it over to you to chat a little bit more about some of the logistics on the training.
Thank you, Brianna. You did a great job. A lot of information there. So yes, this 3-part series that Brianna is teaching we're going to have one every single month, July 9th, August 13th, and September 10th. Want to make sure that our clients are getting what they need to make sure they are successful for 2026. I will be posting the link to those series. We are offering a discount of 20% currently this month. So our courses are $149 each, but with the discount, they would drop it to $119. So definitely look into that. It's definitely going to be something you're going to want. It's definitely detailed with what you're going to get of each course and series. So please reach out if you have any questions. Other than that, I do just want to say thank you so much for your time here today. Brianna, again, thank you so much for all that you have done.
Yeah, absolutely. And I did see a couple of hands. If you'd like, we're happy to take a couple of questions in the few minutes that we have left here. Otherwise, you're more than welcome to reach out to me at my email or again, message me on LinkedIn.
Yes, I apologize. So we do have one question. I was back on slide 8, and it says, how much are fees suspected to be? Can you answer that, please?
Yep, I believe for Senate Bill 261, the TCFD aligned report, I believe the penalties can be up to $50,000. For Senate Bill 253, the greenhouse gas emissions reporting, I believe the penalties can be up to $500,000. Good question.
All right. I think that's all the questions that we have. Please reach out to me or Brianna if you have any other questions or need anything at all. Thank you so much for attending today's webinar.